10 years, that is how long it took for one diligent saver to realize. The money she trusted to her bank had been quietly hollowed out from the inside. She checked her balance one evening, saw a number that looked healthy, and she felt a brief wave of pride. Then she tried to buy what that same amount could have purchased a decade earlier. The gap was brutal. Thousands of dollars in purchasing power had simply evaporated. Not through bad luck, not through reckless spending, but through the very act of saving responsibly. Nobody warned her about that part. You've probably been told since childhood that a savings account means financial security. Put your money in the bank, let it grow, be patient. It sounds like wisdom, it feels like discipline, but run the actual numbers for even 5 minutes and the entire story falls apart. Say you deposit $1,000 today. Your bank offers you 0.5% in annual interest. At the end of 12 months, you collect $5, just $5. Meanwhile, inflation is running at roughly 3% a year. That means the real value of your $1,000 shrank by about $30. While you were busy feeling responsible, you earned 5, you lost 30. Net result, you're $25 poorer than the day you walked through those glass doors. Not because you did something wrong, because you did exactly what you were told. Here is where it turns from disappointing to something closer to architectural. While you collect that 0.5%, the bank takes your deposit and lends it to someone else at 15, sometimes 20% interest. Your $1,000 isn't resting in a vault with your name etched on a drawer. It is out working around the clock, generating returns, and almost none of that profit circles back to you. You're the raw material. They're the factory. And the factory runs one more operation most people never hear about. When you hand over that $1,000, the bank holds a small fraction on reserve. The rest gets lent out immediately. So your 1,000 still shows in your account. But 900 of it is now sitting in a borrower's account as a completely fresh loan. 1,000 became 1,900. The bank just manufactured $900 that didn't exist 5 minutes earlier. They charge interest on every cent of that invented money. Multiply this across millions of accounts every single day, and you start to see the real scale of what is happening behind the polished lobby and the warm handshake at the door. This isn't speculation. It is called fractional reserve banking, and it is entirely legal. The system doesn't even hide it. It simply counts on the fact that you'll never look closely enough to notice. Your deposit isn't a deposit in the way you imagine it. It is a license for the bank to create new money, earn interest on that new money, and pay you almost nothing for the privilege of using yours as the starting fuel. So the belief you grew up with that putting money in a bank is safe is not just incomplete. It is the precise mechanism that transfers your wealth onto someone else's balance sheet, one quiet percentage point at a time. The real question isn't whether banks are good or bad. It is how many years of your life you've already spent funding a system, engineered to keep you standing perfectly still while everything around you moves forward. Pull up your own savings account right now, find the interest rate your bank is actually paying you, and hold it next to last year's inflation number. That single comparison might be the most uncomfortable 5 seconds of your entire week. Drop what you find in the comments, because what comes next makes this look gentle. Somewhere right now, a person is opening a credit card statement, realizing a television they bought for $500 has quietly become a $700 television. If they keep making only the minimum payment, that screen sitting in their living room will cost them $1,000 before the balance finally hits zero. They'll have paid double for something that lost half its value the very moment they unboxed it. And the bank that made this possible will collect every extra cent without ever knocking on their door. That is arithmetic, working exactly as designed. The average credit card charges roughly 20% interest. 70% of people carrying credit card debt right now admit they can't pay it off in full this year. Most of them have no idea when they will. And the bank doesn't need them to. The bank needs them to stay exactly where they are, making just enough of a payment to keep the account alive and the interest compounding. Now step out of that apartment, leave that statement on the kitchen counter. Drive across town to a different neighborhood entirely. When Mark Zuckerberg purchased a $6 million home, he didn't write a check. He didn't write a check, even though he easily could have. $6 million is loose change when you're worth tens of billions. Instead, he walked into a bank and took out a mortgage at just over 1%. At the time, inflation was running higher than his interest rate. Read that again. The bank essentially paid him to borrow their money. The real cost of that loan was negative. He gained purchasing power by going into debt. Now, go back to that kitchen counter. The person staring at their credit card bill wants to buy a home too. They walk into the same banking system, sit across from a loan officer at the same kind of desk, and the number they hear is 4%. 4%, or maybe even more. 4 times what the billionaire paid. The person who needs the money most gets charged the highest price for it. The person who needs it least gets handed a discount so generous it barely qualifies as a cost. Banks have a polite name for this. They call it risk management. But run the numbers yourself and see what risk management actually produces. A worker borrows at 4% and spends 30 years paying off a home. That may or may not appreciate enough to cover the interest. A billionaire borrows $100,000 at 2%, watches the property climb 20% in a single year, sells it, repays the loan plus $2,000 in interest, and pockets $18,000 in pure profit. No labor, no overtime, no second job. Just debt, working in reverse, building wealth instead of destroying it. This is the part that should make your stomach turn. It is the same institution, the same product, the same word on the contract, debt. But it functions as a cage for one person and a printing press for another. The ordinary borrower takes on debt to cover a car payment or an emergency bill, things that lose value the moment the ink dries. The wealthy borrower takes on debt to acquire assets that inflate in price, while the loan stays fixed. One person sinks, the other floats, and the bank sits in the middle, profiting from both directions. Billions borrowed at nearly 0%. Entire portfolios leveraged against low-interest credit lines. Assets appreciating faster than the cost of the loan. That isn't a conspiracy theory. That is a spreadsheet anyone can build. And if you think the math stops here, consider what happens when those billionaires need cash but refuse to sell a single share, because the tax bill on $100 billion in gains would be $20 billion, and no one writes that check voluntarily. What they do instead might be the most elegant financial maneuver you've never heard of, and it is worth understanding before you make your next deposit. Here is something that should unsettle you. Right now, roughly $8 trillion sits in places most people will never visit. Bermuda, the Cayman Islands, Switzerland. Not in vaults guarded by criminals. In accounts managed by the same institutions that hold your checking balance. That money belongs to corporations and individuals who figured out long ago that the financial system has 2 separate doors. One for people who own things and one for people who work for things. You walk through the second door every single day without realizing the first one exists. This isn't a glitch. It is the architecture. Ownership of assets unlocks a parallel economy where wealth circulates without ever being taxed. The tools that make it possible aren't hidden in some underground market. They're legal structures built by the same banks that process your paycheck. Consider how a company earning $100 million in U.S. profit can create a subsidiary on a small island, license its own patents to that subsidiary, and pay itself $70 million in artificial fees. On paper, the American profit shrinks to $30 million. The tax bill drops from $21 million to $6. The $70 million sits offshore, untouched. Multiply that across thousands of corporations, and you begin to see how 10% of the entire global economy simply vanishes from the tax base. Then there is the asset you were told would make you wealthy, your home. You sign for a $300,000 house with a 30-year mortgage at 4.5%. The monthly number feels reasonable, but follow the payments to the end. You hand over close to $600,000. Half of that goes directly to the bank as interest. Add property taxes, insurance, a new roof, plumbing that fails at the worst moment, and the true cost climbs further still. The bank faces almost no risk. It collects guaranteed interest month after month. If the market crashes the way it did in 2008, you absorb the loss. Your equity disappears, but the bank still holds the note. So here is the picture once you pull back far enough. One group borrows against what it owns, never sells, never triggers a tax event, and watches wealth compound in silence. The other group earns, gets taxed immediately, borrows at higher rates, and pays double for the largest purchase of their lives. The distance between those two realities has nothing to do with effort. It is about which door the system opened for you the day you walked in. Imagine someone sitting at a kitchen table on a Tuesday night, scrolling through 3 months of bank statements they finally printed out. They're circling charges with a red pen, $17 here, $9 there. A $35 overdraft fee triggered because a subscription they forgot about hit 2 hours before their paycheck cleared. They add it all up, and the number staring back at them is $411 gone. Not spent on food, not spent on rent, not spent on anything they can point to in their home, just gone. Absorbed quietly into a system that was never designed to send them a warning. That scene isn't hypothetical. Banks in the United States alone pull in over $30 billion a year from overdraft fees. $30 billion. That isn't revenue from loans or investments or some sophisticated financial product. That is money scraped from people who went $10 past zero and got charged $35 for the privilege. Run the math on that single transaction. You borrowed $10 you didn't have. The bank let it go through, not as a favor, but because approving it meant they could bill you $35. That is an effective rate of 350%. No loan shark on earth advertises that number, but your bank doesn't have to advertise it because it is buried on page 9 of a document you signed without reading. Now pull the camera back further. It isn't just overdraft fees. There are maintenance fees for keeping your account open, inactivity fees for not using it enough, foreign transaction fees for swiping your card on vacation. Each one looks like pocket change on a single statement, but multiply those small cuts across 12 months and across millions of accounts, and you start to see the architecture. The system earns its deepest profits not from dramatic events, but from charges so small you feel embarrassed to complain about them. That embarrassment is part of the design. And here is where the tilt becomes obvious. The interest your savings account earns sits below 1%. The interest you pay when you borrow climbs to 10, 20, sometimes 30%. That gap isn't an accident. It is a signal. The entire structure whispers the same message. Don't save, borrow instead. Spend now. Figure it out later. Student loans lock young people into decades of payments before they earn their first real salary. Car loans stretch to 7 years. Credit card minimum payments are calculated to keep you revolving for as long as mathematically possible. Debt isn't a side effect of the banking business. Debt is the product, and you're the customer they never want to lose. So what do you actually do with all of this? Not a 5-year plan, Not a portfolio strategy, not some complicated spreadsheet. One action, boring, mechanical, almost stupidly simple. Every Sunday morning, before you check social media, before you make coffee, you open your banking app and scroll through the last 7 days of transactions, checking them line by line. Every single charge, you screenshot anything you don't immediately recognize. Then you spend 10 minutes, just 10, calling or chatting with your bank to ask what each unclear charge is and whether it can be reversed. That is it. No budgeting software, no financial advisor. Just your eyes on your own numbers once a week for 10 minutes. Most people who start doing this discover between $40 and $100 a month in charges they never consciously agreed to. Some find subscriptions still billing from 2 years ago. Some find fees they qualify to have waived simply by asking. The bank won't volunteer this information. They have no reason to. Those small amounts multiplied across your lifetime are exactly how the machine feeds itself. You aren't going to outrun a system built over centuries by being clever. You outrun it by being boring, by looking where they count on you, never looking. 10 minutes every Sunday. That is the smallest knife sharp enough to start cutting yourself free. Here is what nobody tells you at the end of a video like this. Absolutely nothing. Changes tomorrow morning. You'll still wake up, check your phone, drive to work, and watch the same direct deposits land in the same account at the same bank. The marble floors will still be polished, the teller will still smile, and every mechanism we just walked through will keep grinding exactly the way it was designed to grind. That is the honest version, and honest is the only thing worth being right now. But here is what actually matters. Imagine 2 versions of yourself 12 months from now. The first version watched this video, felt a brief surge of frustration, closed the tab, and never opened a single bank statement with any real intention again. Nothing dramatic happened to that person. Nothing dramatic needed to happen. The system doesn't require a catastrophe to drain you. It just needs you to stay still. Now, picture the second version. That person did one thing, not 10 things, just one thing. Maybe it was pulling up the actual interest rate on a credit card and writing it on a sticky note next to the bathroom mirror. Maybe it was setting a weekly window just to read the transaction list from the past 7 days, not to budget, not to panic, just to look. That single act repeated does something no bank will ever advertise. It builds a buffer. Not a buffer of cash, although that comes later, a buffer of awareness. A payday lender can't surprise someone who already knows their balance to the dollar. An overdraft fee can't ambush someone who checked their account that morning. The system feeds on fog, and you just turned on a small light. I'm not promising wealth. I'm not promising that awareness alone erases the gap between a 2% borrowing rate and a 20% one. That gap is structural. It existed before you were born, and it will exist after this video disappears from your feed. What I'm promising is that you now have the option to see. You have the exit door marked on the map, whether you walk through it and how fast. That depends on decisions only you can make. In kitchens and parking lots and late nights that no video creator will ever witness. Open your banking app tonight, not to transfer anything, not to close anything. Just scroll through the last 30 days and find one charge you didn't consciously choose. One fee, one subscription, one autopay you forgot existed. Find it. Stare at it. That is your proof that the machine runs whether you're watching or not. Drop a comment and tell me the one line from this video that made you pause, the one moment where the math hit different than you expected. I read those comments because they tell me what to dig into next. And the next piece of this puzzle is already being built, based on what people like you are asking.